Welcome, everybody. My name is Michael, and today we're discussing about the CEO of Silicon Valley Bank, the fiasco that ensued, and how Silicon Valley and the tech crisis has impacted the Dow Jones historically. So recently, Silicon Valley Bank is the second largest bank to shutter. Right now, the CEO of Silicon Valley Bank is in a little bit of hot water. He sold $3.57 million of stock 2 weeks before the trouble started. And also, the CFO dished $575,000 the exact same day, and a couple other employees as well. But we're talking about over $4 million by two individuals, two executives who knew exactly what was coming. And right now, you have a huge ripple effect. So one person had over $10 million in Silicon Valley Bank. So the Dow Jones crashed 345 points. This is the largest crash we've seen over the past 2 years. Silicon Valley Bank was seized by the FDIC recently on Friday. And right now, there are tons of people that will lose a bunch of money because the FDIC only insures up to $250,000 in each bank account. So if you have over $250,000, such as the person with $10 million, she's going to get $250,000 back. She's an investor. Of course, she's got a ton of money, and she's probably not going to be hurting that much. But losing almost $10 million, oh boy, that's pretty crazy. So what led to the downfall? And right now, Treasury Secretary Janet Yellen is a little worried. She is monitoring a few banks that are related to Silicon Valley Bank and could potentially also have trouble down the road. So what's interesting is in Manhattan, the cops were called in New York City for Silicon Valley Bank's Manhattan branch. Investors were trying to pull out their life savings. We had a run on the banks. This is absolutely crazy. The headquarters is closed. And right now, this is sending ripple effects all throughout Silicon Valley and other tech companies. And there's huge layoffs in tech. If you've been living under a rock the past couple of months, it's rather tough. If you're middle class, upper middle class, or even higher, working for remote jobs in tech industries, it is very, very difficult to get hired right now. And part of that is there's a big recession for the tech industry. And it's only affected the tech industry, similar industries surrounding it, but it is a crazy thing to just witness. So the FDIC seized SVB's assets today, and this is supposedly they had $209 billion in assets. This is the largest seizure and largest collapse since 2008 and that huge recession. And right now, anybody, again, over $250,000, you're at risk of losing your money. There's a huge run on the banks. And not only that, but people outside of SVB in the tech industry are at risk of losing their paychecks. So payroll was impacted by companies that use SVB's system, even if you're an employee who's never heard of Silicon Valley Bank before. It doesn't matter. Thousands of companies will be impacted. Thousands of people, tens of thousands potentially, on these payrolls will be impacted. This is huge. You're going to have a lot of people who can't pay their electricity bills or rent or anything right now. And yes, most of these people are a little better well off, but it's pretty crazy. It doesn't matter whether you have $1 million in the bank, $100 million, or $2, because this sucks either way. This is something that was out of most of our control, unless you're an executive working in Silicon Valley for one of these banks. And this follows after Washington Mutual. This is huge. So Washington Mutual, at its collapse in 2008, had $307 billion in assets. SVB right now, 2023, over $200 billion. Continental Bank back in 1984 had $40 billion. IndyMac back in 2008, $32 billion. American Savings Bank back in 1988, $30.2. So as you can see, Washington Mutual and SVB are huge. They're eclipsing all of these banks that came before. So definitely this will have, it already has had an impact in the Dow Jones, all the stocks, cryptocurrency has been down, everything's been impacted. So what led to this? So investors have had less appetite for investing recently over the past year due to increased risk. So when interest rates are going up, there's increased risk. You want to hold on tight to your money because you don't know what's around the corner. You don't know what's going to happen. And right now, for banks like Silicon Valley Bank, where most of their technology-based investors were risk-averse and working with a lot of tech startups, they suddenly lost a huge portion of what they were predicting for investments. That is a big part of that. So a lot of initial public offerings began to shut down, and suddenly you had to find, as an investor, as a startup, as a company, as a client of Silicon Valley Bank, you had to find private fundraising. But private fundraising is more costly. It's also a lot more difficult to get. So you already have some money in the bank. Might as well take that out. Well, suddenly you had a ton of people and huge startups that wanted to take their money out, and Silicon Valley Bank wasn't prepared because many banks in America have previously it was a fractional reserve system. During COVID, some banks had 0%. You could have gone down to zero, but let's just say a bank has 10% of the funds. So they have $100 billion worth of clients' money. They only have $10 billion in all the bank branches. And suddenly the economy collapsed, and you have a situation where, startups, big companies want to withdraw millions of dollars each. Well, that's a problem because on top of everything else happening, the bank cannot afford to give back to every single person who suddenly wants that money. And they have to come out with innovative ways to pay back customers. Oopsies. So to fund the customers that want their withdrawals, they decided to sell their entire bond portfolio at a loss. This was a $21 billion bond portfolio. U.S. bonds, U.S. treasuries. The portfolio was yielding an average 1.79%, which is far below the 10-year treasury yield of around 3.9%. This forced SVB to realize a $1.8 billion loss. So, what else did they do? They did a stock sale. They would sell $2.25 billion in common equity and preferred convertible stock to fill the funding hole. Except there was a problem. People already understood what was happening, and the stocks plummeted. So much so that after trading ended that day, shares plummeted 60%. People were freaking out. So, with the stock sale collapse, essentially, and a bunch of people spooked and trying to take out their money, the capital raising efforts collapsed. And then SVB decided to look for other alternative ways, including a sale of the company itself. However, before that occurred, the FDIC, the Federal Deposit Insurance Corporation, shut down SVB. And it's now placed under receivership. And all the funds were seized. The assets were seized. And that's that. And now, some people might lose their money. Some people might gain a portion back. Future dividend payments will be made to uninsured depositors. And, anyone who had $250,000, it's going to be a long process. But most people will get their money back who didn't have that much money. It sucks because you're not going to have access to that money for a while now, but it's crazy. And obviously this is impacting the tech segment, which is impacting crypto. So some crypto, some stocks are down, but very, very interesting story. And it's crazy because it's an industry that wasn't impacted for a long time. So this can happen anywhere. And that's why you should say goodbye to the banks. Welcome to crypto. All right, that was a pretty cool segment, right? Anyways, thanks for watching today. You have a good one. Take care. And hopefully you guys celebrated International Women's Day. And we've got some other flowers over there. Yeah, pretty nice. All right, have a good one.